Good morning and welcome to the Killik podcast for the 4th of September. Another volatile week on low volumes as the summer draws to a close. And we've had two bits of economic data that sent the market down quite aggressively early in the week. That's a piece of Chinese and a piece of US data. And then we saw the rebound later in the week as Mario Draghi talked at the ECB conference, having held rates on hold, but said they are willing, ready and able to respond to any weakness in the European economy. So two dynamics pushing markets around. Firstly, the Chinese slowdown, which everyone is increasingly aware of, and we've been talking for a long time. We continue to think this slowdown is gradual. We think the policymakers will insulate the slowdown through extended easing policy. And we also feel that a lot of this weakness has been offset by a growth in developed market real consumption growth, which is really coming through in the last quarter. So we feel that this issue, this slowdown that people are very aware of, will pass in due course. The ECB announcement yesterday that they were very ready to step in and increase the QE has sent the euro down against the US and the yen. That's had quite a dramatic effect on the Japanese market overnight. And so we're back into this competitive devaluation scenario for China, Japan and Europe. And that's got implications about US and UK monetary policy. And will impact the rate decision in the US in September in 2 weeks probably. So we've got the US jobs report out later this afternoon, and that will be important for setting the tone of markets later today and early next week. I think the market probably needs a strong number to be reassured on growth rather than worrying too much about the implications of higher rates on developed markets, but we'll see. So just stepping back and looking at this in terms of the longer term picture, the pullback we've had in markets is not unusual. So if we go back to March 2009, we've had 16 falls in the S&P of 5% or more. And since 1978, after a 5-day sell-off of 10% or more, the market's been up 3 and 6 months following. So if we're not in a very serious bear market, which we don't think we are, then this is a good entry point for investors. So just looking in Europe, outside of those big corrections in 72, 2000 and 2007, the MSCI Europe index is now down 16% from the peak, which is the average correction in terms of magnitude and length. So perhaps this is sort of getting towards the end of its sort of pullback. So for us, the setup looks pretty attractive. So valuations relative to bonds look extremely attractive for the equity market on a relative basis. Economic data remains stable and growing, and that's really important. So we're not seeing a collapse in the economic environment, but sentiment is very poor, very fragile, and positioning is very defensive. So that's a good entry point because that can reverse, and we'll see increases in the values of risk assets. So where are we looking to add to? Well, we're looking to shift some of the exposure to areas that aren't related and insulated from these Chinese and emerging market issues. So for us, the two main sectors on the value side of the coin are financials and telecoms. Here you've got the financial index, which you see there's a sort of fairly large pullback over the last couple of weeks, and equally, but slightly less so in telecoms. So the stories, we've gone through a number of times. So declining cost of capital, non-performing loans in financials. We're seeing loan growth coming through and fee income growing. We've also got that upside as interest rates go up with net interest margins. And then in Europe, in the telcos, it's trough margins. These businesses are operating at sort of cyclically very low margins. We're seeing industry consolidation led by the regulator, and we're seeing that structural shift from voice to data and more data coming through, raising average revenue per user. We're also using this pullback to add to those strong structural growth stories, primarily in content where we've got Disney, which is 17% off the top. Also in payments, where we've got Visa around 10% off their highs for the year. And finally in Accenture, which is our way of accessing this sort of growth and importance of digital economy for existing businesses. So all looking at better value after the last couple of weeks. The week ahead again is light on corporate news flow. We've got a couple of house builders, so that'll be interesting, and a couple of asset management houses. Particularly Ashmore Group is of particular interest because they are in the eye of the storm in terms of this emerging market volatility and fear. So you've seen the asset managers perform relatively poorly over the last 3 months because of this volatility, and exchanges, the sort of other side of that coin, like the LSE and Deutsche Börse, performing pretty well as they benefit from the increase in volatility. The read across to Aberdeen will be important for Ashmore results, where Aberdeen have got around 20% of their assets under management in emerging market and Asian equities. We continue to feel that the Scottish Widow deal is a game changer for Aberdeen. It shifts their emphasis increasingly away from that part of the world, but it also increases additional operational leverage, which will support increasing cash generation and support the dividend yield, which at the moment is twice covered, yielding 6%. So that's it from me. Thanks very much.